Okay, raise your hand if the FINRA Series 7 exam has made you want to throw your textbook out the window. Yeah, I see you. We're fixing this together. I'm pulling back the curtain on how examiners actually build these questions to trip you up. We're diving deep into the option strategies that haunt your dreams, the municipal bond math that feels like a trap, and the suitability scenarios that require a detective's eye. By the time we're done, you'll see the test through the eyes of the person who wrote it. Let's get to work. Most people study the rules, but they don't study the test. We're going to bridge that gap right now. I want you to stop looking for the right answer and start looking for the logic behind why the wrong ones are there. Ready? Let's roll. Now, here's the thing about options. Examiners love to bury the actual strategy under a mountain of premium data and strike prices. But so, watch this. Why do these even exist? Think of a protective put as car insurance for your stocks. You pay a premium to make sure you don't lose everything if the market crashes. Now, an examiner is going to write a question where a client is concerned about a downside moves, but also wants to generate income. This is where students get stuck in a mini debate. Do I protect or do I earn? If the goal is protection, you MUST buy that put. If the goal is income, you sell the call. What I see students do is pick the income play when the client is actually terrified of a crash. Don't fall for it. Protection equals buying power. Imagine you're standing at a crossroads and you know something big is coming, but you have no clue which way the wind will blow. That's a straddle. The examiner will describe a company about to release a massive earnings report or a pending lawsuit. They want to see if you recognize that volatility is the keyword. The wrong answer is usually a spread. Why? Because spreads limit your profit. In a straddle, you want the stock to explode in either direction. The thing nobody tells you is that if the question mentions neutrals or stable, you're looking at a short straddle, which is the exact opposite. Stay sharp on the direction. Okay, quick reset. Spreads are just a way to reduce the cost of a position by giving up some of the upside. An examiner will give you two options and ask if it's a debit or credit spread. Don't overthink the math. Just look at which option is more expensive. If you're buying the heavy one, it's a debit. If you're selling it, it's a credit. Students often panic and try to calculate the max gain and loss immediately, but the question is usually just asking for the sentiment. Are you bullish or bearish? Actually, let me back up. Always identify the dominant leg first. That tells you everything. Right, moving on to Muniz. Examiners write these questions to see if you understand the public nature of the debt versus the private benefit. Think of geobonds as a loan backed by the power to reach into people's pockets, taxes. They exist to build things that don't make money, like police stations or schools. The examiner is going to test your knowledge of statutory debt limits. Why? Because you can't just tax people forever. The wrong answer often suggests these are backed by user fees. Nope, that's revenue bonds. What I see students do is forget that voter approval is the big gatekeeper here. No vote, no geo bond. It's that simple. Now, revenue bonds are a different beast. These are for projects that pay for themselves, like a toll bridge or a stadium. The examiner wants to know if you understand the flow of funds. This is where they get sneaky. They'll ask about a net revenue pledge versus a gross revenue pledge. Think of it this way, who gets paid first? In a net pledge, you pay the electric bill and the janitors before the bondholders. In a gross pledge, the bondholders are at the front of the line. It's all about the order of operations. So watch this. This is the classic, is it worth it calculation. Why does this matter? Because a 4% muni might actually be better than a 6% corporate bond if you're in a high tax bracket. The examiner will give you a client in the 37% bracket and ask for the comparison. The trick is to remember that the government always wants their cut of the corporate bond. Students often divide by the tax rate instead of 1 minus the tax rate. Don't let the decimal point scare you. It's just a way to level the playing field so you can give honest advice. Okay, buckle up. This next bit catches even experienced candidates. We're talking about margin, and the math here's unforgiving. Good. Okay, there's Margin is just leverage, borrowing money to buy more than you can afford. The problem is, if the stock drops, you're on the hook. Reg T is the Fed saying you need at least 50% skin in the game. An examiner will set up a scenario where a client buys $2,000 worth of stock. You might think they need to put up $1,000, right? Wrong. FINRA has a $2,000 minimum for new accounts. The thing nobody tells you is that for small trades, you pay the full amount, but between $2,000 and $4,000, the requirement is always exactly $2,000. It's a flat fee trap. Let me put it another way. What happens when the market goes south? The maintenance requirement kicks in. For long accounts, it's 25%. The examiner is going to ask you at what point a maintenance calls happens. Here's the reframe. Don't just memorize the formula, debit or 0.75. Think about it as the point where your equity is exactly 1/4 of the total value. If you fall below that, the house calls you to cough up cash or they sell your shares. It's a brutal reality of trading on borrowed time. SMA is basically a line of credits that appears when your stocks go up. It's like a home equity line. The examiner loves to ask what happens to SMA when the market drops. Here's the secret. SMA is like a trophy. Once you earn it, you keep it, even if the market crashes the next day unless you use it. Students often think SMA disappears when the account value falls. It doesn't. It's a high water mark for your buying power. Use that to your advantage on the test. Stay with me here. We're shifting to mutual funds. Let's think about this differently. Boss. Yeah. Most people think of these as the same, but they're built totally differently. An open-end fund is like a bakery. They bake a new cake every time a customer walks in. A closed-end fund is like a limited edition sneaker drop. Once they're out, you have to buy them from another person on the street. The examiner will test if you know that closed-end funds trade on supply and demand on an exchange, while open-end funds are priced once a day at NAV. The wrong answer usually says open-end funds trade in the secondary market. They don't. They're always primary issues. So, watch this. This is all about how the broker gets paid. Class A shares have a front-end load, you pay at the door. Class B has a back-end load, you pay when you leave. Class C is a level load, you pay as you go. The examiner will ask which one is best for a long-term investor. The answer is almost always Class A. Why? Because of breakpoints. If you're investing a lot of money, the fund gives you a discount. Class B and C don't usually offer that. It's like buying in bulk at Costco. It's cheaper in the long run. Now, here's the thing. What is a 12b-1 fee? It's basically a marketing tax. The fund uses your money to pay for advertising and to pay brokers to keep you in the fund. The examiner wants to know the limit. To be called a no-load fund, the 12b-1 fee can't exceed 0.25%. If it's higher, it's not a no-load. The thing nobody tells you is that this fee is annual, so it eats away at your returns every single year. It's the silent killer of performance in the eyes of a savvy investor. Right, let's talk about the why behind the rules. Suitability isn't about what's legal, it's about what's right for the person sitting across from you. Ask it. Here's the exam day version. Examiners love writing questions about grammar. She's 80, retired, and needs income. Should you put her in a tech-heavy growth fund? Obviously not. But they'll make the growth fund sound amazing. It's outperformed the S&P for 5 years. Don't get distracted by the performance. Look at the objective. If she needs income and preservation of capital, you look for bonds or preferred stocks. The wrong answer is the one that chases returns while ignoring the risk of her losing her grocery money. Here's the exam day version. Variable annuities are hybrid, part insurance, part investment. The big selling point is tax-deferred growth. But here's the examiner's favorite trap, putting a variable annuity inside an IRA. Why is this a bad move? Because an IRA is already tax-deferred. It's like wearing 2 raincoats. You're paying extra fees for a benefit you already have. If you see a question where a client has a fully funded IRA and wants more tax-deferred savings, then, and only then, do you look at the annuity. Now, here's the thing. Churning is when a broker trades just to generate commissions. It's not about the money the client makes, it's about the frequency and the size of the trades compared to the client's goals. An examiner will show you a conservative client with 50 trades in a month. Even if the client made money, it's still churning. What I see students do is justify the trading because the account is up. Don't do that. The motive is what's on trial here, not the result. Okay, last stretch. This is the keep the game fair section. It's about the paperwork that keeps you out of trouble. All the matery. Let me put it another way. These are your permanent records in the industry. The U4 is your entrance ticket. It lists your history, your crimes, if any, and your residence. The U5 is your exit ticket. The examiner wants to know the timing. You have 30 days to update the U4 for most things, but only 10 days if it's a statutory disqualification like a felony. If you leave a firm, they have 30 days to file that U5. The thing nobody tells you is that even after you're gone, FINRA still has their eyes on you for 2 years. You can't just quit to avoid a disciplinary hearing. Is it correspondence, retail communication, or institutional? This sounds boring, but the examiner uses it to test your compliance knowledge. Correspondence is to 25 or fewer retail investors. Retail communication is to more than 25. Why does it matter? Because retail communication usually needs a principal's approval before you send it. Correspondence just needs a review. Students mix these up because they forget the magic number is 25. Remember, 25 is the line between a quick check and a formal filing. Right, quick note. This is the pay-to-plays rule. If you want to do muni bond business with a city, you can't just write a massive check to the mayor's re-election campaign. The limit is $250 per election, and only if you can vote for them. If you can't vote for them, the limit is $0. If you break this rule, your firm is banned from doing negotiated business with that city for 2 years. It's a massive penalty for a small check. The examiner will try to trick you by saying the broker lives in a different district. If they can't vote, they can't pay. We've covered a lot of ground today, from the mechanics of a spread to the ethics of political contributions. The key isn't just knowing the facts, it's knowing how those facts are used to build a challenge. Remember, every question has a why behind it. When you see a question on the Series 7, ask yourself, what is the examiner trying to see if I know? Is it the risk? Is it the tax implication? Is it the rule? Once you see the pattern, the answer becomes obvious. You got the tools, now you just need the reps. 3 things to walk away with: know the patterns, watch for the traps, and TES. T yourself, don't just reread. Head to FraserExam.com for free, FINRA, Series 7 exam practice test, so you can put all of this into actual practice. Like and subscribe if this was useful. Now go get that passes notice.